Do you know that the United States is facing inflation? Where will this inflation take the US economy? The United States is one of the richest countries in the world. It is renowned for having advanced technology and a stable economy. However, the world was shocked by the news that the US is facing inflation. People are wondering, what could be the possible reason for this? What is inflation? How quickly prices are increasing for goods and services in an economy is gauged by its level of inflation. It may not be good for society if inflation occurs and essentials like food become more expensive. Inflation can harm almost any good or service. Why does this take place in America? Employers eliminated a startling 22 million jobs in the spring of 2020. When the epidemic halted the economy, lockdowns began, firms stopped or cut hours, and customers stayed home for health concerns. The economy fell at a record-breaking 31% per year in the April to June quarter of 2020. Businesses reduced their investments and delayed ordering more goods. Now, will the economy recover from inflation? Stay with us for more. How will this inflation impact the U.S. economy going forward? Here are 7 ways the U.S. inflation rate may impact the nation's economy as we discuss further. Number 1. Disproportionately harms impoverished people. Comparatively to those with higher salaries, those with lower incomes tend to spend a larger percentage of their total income on needs. As a result, those with lower salaries are less protected from the erosion of their purchasing power brought on by inflation. This is what economists mean when they assert that a lower income is accompanied by a larger marginal willingness to consume. The cost of food and energy are more volatile and don't reflect the long-term pattern of inflation as well. Inflation is the main concern of policymakers and those who work in the financial markets. However, most people in emerging nations and those with lower incomes spend a large portion of their weekly or monthly budgets on food and energy, which are difficult to replace or live without when costs rise. Number 2. Keeps deflation at bay. To keep prices steady and ensure that as many people as possible can find work, the Federal Reserve wants inflation to be 2% over the long run. Instead of aiming for steady prices, it prefers modest inflation since it facilitates trade. It provides a safety cushion in case inflation is underestimated. It deters deflation, a broad decline in prices, and can be far more unstable than inflation. Lenders can raise interest rates in response to the likelihood that inflation will reduce the purchasing power of payments. When the economy is struggling, workers frequently push back against attempts to reduce their pay. The most likely remedy for firms is to fire employees. Freezing salaries is the same as reducing labor expenses when the inflation rate is positive. When inflation rises above what is typical and anticipated, it loses its ability to fend off deflation. Inflation, if it rises too high, can spiral out of control. Number 3. It feeds itself when it's high. As we've demonstrated, a tiny amount of inflation can indicate a healthy economy and is unlikely to lead people to believe that inflation will increase in the future. If inflation is the same as last year, 2%, that is largely unimportant. In that circumstance, firms, employees, and customers will likely anticipate that inflation will remain at 2% in 2019. However, suppose the rate of inflation increases swiftly and remains high, people will gradually begin to anticipate higher inflation rates. Employers pass on these expenses by boosting output prices as expectations build and workers demand larger pay raises. This sets off a downward spiral in both wages and prices. In the worst case, hyperinflation could occur if politicians don't adequately address excessive inflation. Number 4. Renewed interest rates. There are numerous justifications for governments and central banks to control inflation. Monetary policy has been employed to reduce inflation in the United States and other countries for the past 100 years. Policymakers can increase the minimum interest rate when inflation threatens to exceed a central bank's target, typically 2% in the industrialized economies and 3 to 4% in emerging economies. This restricts the amount of money in circulation, raising borrowing costs for everyone in the economy. Because of this, inflation and interest rates frequently move in the same direction. Central banks can reduce pricing pressures in the economy's animal spirits or desire to take risks by hiking interest rates when inflation rises. The anticipated monthly payments for that boat or the corporate bond issue for a new expansion project are excessive. The risk-free rate of return on newly issued treasury bonds will often increase, making it more advantageous to save money simultaneously. Number 5. Quickly creates more employment and growth. In the short run, higher inflation can hasten economic growth. The United States' real gross domestic product, or GDP, expanded by an average of 3.2% per year between 1970 and 1979, even though the 1970s are regarded as a decade of stagflation. This is much faster than the economy's average growth rate since then. People are less willing to save when inflation is strong because their savings depreciate with time. This may increase the company's willingness to make purchases and make investments. As a result, when inflation rises, unemployment initially declines. Higher inflation can temporarily increase demand, cut inflation-adjusted labor costs, and promote employment growth. However, chronically high inflation must eventually be paid for, either by a severe recession that resets expectations or by consistently weak economic growth. Number 6. May lead to devastating recessions. Recessions are not primarily brought on by inflation. Rising interest rates, a decline in bank lending, and a decline in investment typically brings on recession. However, cost-push inflation can cause a recession, particularly if it exceeds nominal wage increases. A recession results when there is a general slowdown in activity throughout an economy. It relates to decreased investments, job losses, dropping stock prices, and a declining GDP. Because of this, governments attempt to control inflation by lowering overall economic activity. To do this, the Federal Reserve in the U.S. raises its base interest rates. The Federal Reserve increases borrowing and lending costs by boosting interest rates. This raises the cost of running many various aspects of the economy, slowing down economic activity overall. Number 7. Bonds and growth stocks suffer as a result. Bonds are typically low-risk investments with set interest rates. A bond's value decreases as a result of inflation, especially excessive inflation, which reduces the present value of an income stream. Interest rates rise along with inflation when it rises or remains high, which also increases the yield on freshly issued bonds. Bond prices are the inverse of bond yields, so bonds that were previously issued with a lower yield will see a corresponding decrease in market value. A treasury bond owner will continue to receive coupon payments. When the bond matures, it will also receive its principal back. However, because market yields have increased, those who sell their bonds before they mature would receive less money. Inflation is bad for growth companies because it reduces the present value of their future cash flows, just like it does for long-term bonds, which are often more expensive. In the past, tech and consumer equities did not do as well when inflation was high or rising. We hope you learned a lot from today's topic and gained a better grasp of what is happening. May these help you prepare for whatever its outcome in the future. Just like you, we're looking forward to the economy recovering and, of course, to more job opportunities for all citizens. What do you think about this topic? Do you agree with me too? Share your thoughts in the comment section below. Don't forget to like, share, and subscribe. I'll see you in the next video.